Capital Account Convertibility (CAC) refers to the ability of residents of a country to freely convert their domestic currency into foreign currency and vice versa. It is done for purposes such as investment, trade, and remittances. CAC is often seen as the final stage of financial liberalization and a key milestone for a country's economic development. Here's an example from a resident's point of view. Let's say an Indian resident wants to invest in a foreign stock market. If India has full capital account convertibility, the resident would be able to freely convert their rupees into the foreign currency required to make the investment. And there would be no restrictions on repatriating the investment back to India. However, if India has limited capital account convertibility, the resident may face restrictions on the amount of foreign currency they can convert and the amount of investment in foreign assets. The resident may also face restrictions on repatriating their investment back to India, or may have to comply with certain regulatory requirements or taxes. So, the level of capital account convertibility affects the ability of Indian residents to invest in foreign markets and access international capital. The benefits of CAC include increased foreign investment, greater access to international capital markets, and reduced transaction costs for international trade and investment. CAC can also help promote financial sector development and encourage the use of local currency in international transactions. However, CAC also comes with potential risks and challenges. Uncontrolled capital flows can lead to financial instability and volatility in exchange rates, and can make a country vulnerable to sudden capital flight. CAC can also exacerbate economic inequality and create potential risks for financial institutions and investors. In India, the path towards CAC has been gradual and cautious. The Tarapur Committee, established by the Reserve Bank of India (RBI) in 1997, recommended a phased approach towards CAC, starting with greater flexibility in capital flows for trade and foreign direct investment, followed by a gradual easing of controls on portfolio investment. The committee recommended that CAC should be achieved in a planned and calibrated manner. Government should take into account the macroeconomic conditions and the ability of the financial system to cope with the potential risks. The committee also emphasized the importance of maintaining fiscal and monetary discipline, strengthening the financial sector, and improving the regulatory framework to manage the risks associated with capital flows. India has made progress towards CAC over the years, with gradual relaxation of controls on foreign investment and portfolio investment. However, full convertibility remains a long-term goal, and the RBI continues to maintain controls on capital flows to manage the risks and maintain stability in the financial system. In conclusion, CAC is a complex and challenging concept that requires careful consideration of its benefits and risks. While CAC can bring significant benefits to a country's economy, it also requires careful planning, monitoring, and regulation. This is to ensure that it does not lead to financial instability or exacerbate economic inequality. The gradual approach recommended by the Tarapur Committee provides a useful framework for achieving CAC in a responsible and sustainable manner.